Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
So let's say I wanted to do a bull put on Biogen, right? So what I can do, guys, is I'm going to pull up my Theta research spreadsheet. I'm going to walk you through kind of the information here. First and foremost, I'm just going to click on the bull put spread, okay? At that point, you're going to see a couple different things. Number one, you need to fill out that information. That's the information you personally need to fill out. Now, as you fill out that information, the performance metrics will tell you whether or not that is actually a good trade. And it will just tell you the ROI, the ATR buffer, and all of that. Okay, so symbol BIIB, price is 332.86. ATR is that $10, Tim? Was that $10? 1048, right?
Now I gotta set my chart. Hold on.
Okay, 1048. The month I'm going to be trading, I'm just going to apply the rules. I'm going to say 31-day contract here. So we're going the month, that would be the second week, March. So I'm just going to put March. That is not necessarily nearly as important as this next thing, guys. The month is not very important. In fact, you could just take that out. But the DTE is important in the calculations, and DTE stands for days till expiration. This expires in 31 days. Now, I need to get the short strike. Now, once again, guys, for those for my veterans out there, who what's the delta I sell for my veterans? What delta do I sell? Yeah, closest to 0.20. Now, can I sell a lower delta than that? Yes, I can sell a lower delta than that. But can I say, you know what, I want to go sell a 0.35 delta so I can get a lot of money? Can I do that? No, I can't do that. Okay, I can't do that. Rules can only be broken when to be more conservative. So on the short strike, I'm going to put the 19 delta, which is the 360 strike price. I'm then going to pick the, oh, excuse me, I was looking at the call side. That made no sense. So the call side delta is the 305 strike price, excuse me on that. So the 305 strike price, the short put delta is 300 strike price. Oh, excuse me, the short put delta is 0.19. Long strike price is the one we're buying as insurance, right under is 300. Net credit, I just got to simulate the trade to get my net credit. So what I do, guys, is I just slide that into the mid price on one contract. The net credit is 1.00. Buying power effect on the net credit would be 400. Okay, so let's change that net credit to 100, excuse me. Okay, so now I got my trade, okay? And as I filled out the numbers, a couple things happened, guys. Number one is you saw the ATR buffer, and it came in at 2.6. Now what that means, ladies and gentlemen, is a standard deviation in a market going down. It will take 2.6 days down for your strike to get hit. Does that make sense, guys? Okay, over here on the right-hand side, we are getting a total of 25% return on investment. Okay, I'll walk you through. I'll take all questions you guys need after I kind of explain it there, Carl. All right, so we're getting a 25% ROI. We're getting a 24.2% standard ROI. Now, the reason you have a standard ROI and you have a ROI column is the ROI column is calculating it based on 31 days in the trade versus the standard ROI column is calculating it at 24.2 days. Now, the reason you have this, guys, is in case you're analyzing two different time frames on the same stock. So if I was analyzing a 4-week contract versus a 6-week contract, obviously the 6-week contract is going to give me a better ROI, correct? If I sell an option 6 weeks out, it's going to give you a higher ROI. So what the standard ROI does is it calculates that per a 30-day number, so that if you're comparing two different time frames, it will standardize it to a 30-day number, so you just don't make a decision on the 25% versus 20% versus 15. You don't want to make decisions based on ROI. You want to make decisions that are calculating, get apples to apples. Does that make sense, everybody? Okay, now the ROID. Okay, the ROID is very important. Now, what the ROID does, and this, it's actually a very simple calculation that I created about, oh, Tim, when was it? 8 years?
Probably about 7 or 8 years ago, I'd say. We were sitting around doing a bunch of mentorship, and when you're working with people, you're trying to get them to understand what you already have in your head. This is why education is such a powerful thing for you as a trader too. When you can teach it, it means you know it better. And you're like, well, guys, it's about probability, ROI, and then the delta. You're looking at both, and that probably 7 or 8 years ago, I'd say.
Well, and I remember making the statement that I called somebody lazy. I can't remember who I called lazy, but that does sound like something I would say.
No, not at all. Does Matt seem like somebody who would be very direct, guys? Maybe every now and then.
I'm a loving guy.
That's true.
But no, I remember we were sent down and somebody was calculating a credit spread, and the old way of calculating a credit spread, ladies and gentlemen, was basically, well, if you get 10% of the spread, then that's a good trade. Has anybody ever heard that before? If you get 10% of the spread, that's a good trade. That comes from old school thinking, is where that comes from. And that comes from, I mean, it's there for a reason. It's been 30 years, right? It's been around since the 80s, since the options market really, oh no, you're good, Carl. Where do you think I heard it originally? But in terms of that, I said, I made the comment that just because you get 10% spread does not mean that's a good credit trade. And I remember looking at a couple different trades, and I said, okay, Tim, you're getting, a 10% ROI selling a 15 delta, and I'm getting a 10% ROI selling a 20 delta. Those, both trades are getting the same thing. Both trades are getting the same 10% of spread. Both trades are getting the same ROI. But there's a massive difference between 75% probability and 85% probability. And when all you say is just to get a 10% of the spread, that is not taking into account probability. And ladies and gentlemen, every trader knows this. Probability is the most important aspect of trading. And when you're, especially when you're dealing with credit spreads, and you're saying, all right, well, Matt, there's not a whole lot of difference between 75 and 80%. Well, guys, there is when you're taking into account the ATR buffer, and there is when you're taking into account the probability of touch. There is those in equations. And so what I said was, what we got to do is we got to, and this was a 2-year process, guys. There's got to be a better way to calculate this. And so what I did was I started backtesting ROID. And what ROID was, and I basically just created all of these parameters for what is a good ROID and what is not a good ROID based on years of data and my own personal trading, Tim's trading, and just backtesting. And basically what I found was when you're looking at a good credit, taking into account both the 10% of the spread factor as well as probability, there are these parameters that make up a good credit spread. So if you highlight kind of over the standardized ROI, guys, what you're going to be looking at is the ROID that we're looking at relative to the 30-day contract again. And so if you're over an 80% ROI, an 80% ROID, that is a fantastic trade, guys.